Hello, everybody, and a very happy day to all of you. Welcome to my YouTube channel. I'm your learning partner, Sushila Hariharan. In this module, we're going to take a look at what are hedge funds. Often we hear in the news channels that hedge funds have withdrawn money from markets, causing the Sensex and the Nifty to crash, or hedge funds have caused the Turkish lira to collapse. So, in this module, let's take a look at what are hedge funds, what do they do, how do they invest, and how do they affect markets and asset prices on a global scale. What are hedge funds? Hedge funds are privately owned, implying that because the investors in the hedge fund are private investors, the hedge fund itself has got very little compliance to disclosures. It's a privately managed entity. Because it's privately owned and it's privately managed, they do not take money from the general public, so to speak. The activities of the hedge fund are known only to the hedge fund and to the hedge fund manager, right? So, therefore, most of the activities of the hedge fund are highly secretive. They do not have to disclose the NAV of the hedge fund. They do not have to disclose their performances to the public. They don't have to disclose the fund fact sheet on a monthly basis, etc. Most of the investors in a hedge fund are private investors, and because they're private investors, like in insurance companies or endowment funds, they perform a very important job, which is keeping activities of their hedge fund in different markets under the wraps. Therefore, the hedge funds are very secretive in nature and face little or no regulatory risk from the local regulators. It's not that they're completely unregulated, but because they do not take money from public, unlike a bank or unlike a mutual fund, their responsibility to report many of the activities is also practically nil. The investors in a hedge fund invest in their private capacity. These could include banks, insurance companies, high net worth individuals, endowments, or even pension funds. Each investor contributes millions of dollars into a hedge fund, and therefore the hedge fund has very few investors, right? Unlike in a mutual fund where we can have millions of investors across the country, in a hedge fund, because just few investors are allowed to invest in the hedge fund, there's a significant contribution by each of those investors into the hedge fund. Most of the hedge fund investments are in equities, which are typically hedged by derivatives. So the hedge fund also takes an exposure on plain equities or just in the derivative market. They also invest in bonds of countries which do not have great sovereign risk, or the sovereign risk is relatively high, and therefore the bond yields would typically be very high. Hedge funds also look at currencies which are very volatile in different parts of the world. They invest in convertible securities, taking a bet on whether the issue of conversion of the debt into equity would be profitable for the fund or not. So, as you analyze the hedge fund's investments, you will realize that they take extremely highly risky investments across risky assets, across risky countries, because they believe in the paradigm that higher risk probably generates higher returns. The investments in a hedge fund stay locked in for a very long period of time, perhaps in the region of 3 to 5 years, where the private investors are not allowed to take out the money for this duration. They invest in highly risky assets across countries and across currencies, across assets like equities, bonds, currencies, commodities, convertibles, etc. There's a high degree of leverage. Leverage means borrowing money to invest in purchasing assets. But leverage is a double edged weapon. Where there is high leverage and there is a bull market, then leverage is your friend. But if the market goes into a downward slump, then leverage becomes your most hated enemy. But leverage is used extensively by hedge funds. Most of the investments by a hedge fund have little or no disclosures to the public because they have not raised money from the public. There is no need for them to disclose to the public. Hedge funds charge tremendous fees from their investors, much higher than what a mutual fund would charge its investors. So, for example, if the hedge fund states that its fees are 2 and 20, then it implies that there is a 2% fixed fee and a 20% fee on the profits. Okay, so 2% fixed fee is a fixed fee of the assets under management. That's the AUM. Whereas if the fund has generated X amount of profit during that 5-year period, then the hedge fund is mandated to pay 20% of that profits as well to the investors. The top hedge funds as of June 2021 include, at the top of the list is Bridgewater Associates managing almost $105 billion. Man Group managing almost $76.8 billion. Renaissance Technologies managing $58,000 million. Millennium Management standing fourth, managing $52,310 million. And TCI Fund Management managing almost $40,000 million. If you add up all this, it works out to almost $500 billion. So that's a lot of money just to be managed by the top 5 hedge funds. And even as we speak, I understand that hedge funds across the world operate almost on a $3 trillion assets under management. So they have big capital. And with that big capital, they are able to influence asset prices across the world, like George Soros showed us way back in 1992, or the collapse of Amaranth Advisors in 2006, or even the shutdown of SAC Capital in 2016. If you like the contents of the show, please hit the like button, share the channel with your friends, and for more interesting tidbits on everything about finance, do subscribe to my channel. I'm your learning partner Sushila Hariharan, wishing you bye bye.